DHHF. This is the Betashares Diversified All Growth ETF. This is an all-in-one investment solution that has 100% allocation to shares. You're going to invest in large, mid, and small cap equities from Australia, global developed, and emerging markets. The fund was made back in 2019. It has a management fee of 0.19%. And you're going to get distributions paid quarterly. Its current one-year return is 18.08%, and its three-year annualized return is 17.07%. This ETF is invested around 36% in Australia, 42% in US, 16% in developed ex-US markets, and 6% in emerging markets. So this ETF is built with an extreme home country bias. In 2023, Australia made up 1.64% of the global market. Your portfolio will be more likely more diversified among the sectors when using all the countries around the world. But the point of this video is to teach you not to have a bias among the ETF providers. So DHF is going to invest only in their products. So if we use the same asset allocation as the Betashares ETF, we're going to test out building a portfolio with the S&P 500 and NASDAQ. Since this ETF avoids the global and US sector category, we're going to use IVV and NDQ to put a little more tech into the portfolio. We're going to use EMKT for emerging markets, IVE for international, and VHY for the Australian equities. All you have to do is pair your favorite ETF from each asset class to the allocation. Looking back almost 6 years, putting $100,000 in DHF, this grew to $181,000. The portfolio with the S&P 500 ETF grew to $201,000. And the portfolio with the NASDAQ grew to $236,000. Taking a closer look at the monthly correlations, IVV was a little more correlated to the other ETFs than NDQ. NDQ will technically give you a little more diversification. DHHF has a compound annual growth rate of 10.64%. So I'm certainly not saying this is a bad ETF, but there is better. The S&P 500 portfolio had similar standard deviation and grew about $20,000 more in the same period of time. The portfolio built with the NASDAQ has a compound annual growth rate of 15.68%. It also had the lowest max drawdown of the portfolios and the highest Sharpe ratio of all three. So by using the recipe the financial institutions give us and a little bit of research, we can build a portfolio that's historically grown better. This might not happen again in the future, but having a little more control of our money has given us more returns in the past. Learning how to click buy 4 times instead of once has given you about $50,000 more in 6 years. And remember, this was only investing $100,000 to start. All you need is a template to work from, and investing can be so easy.